welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on consumer cyclicals, and my guest is David Sekera, Chief US Market Strategist at Morningstar. Well, consumer cyclicals are a story of pandemic winners and losers. 19% of the S&P Consumer Discretionary Index by weight is Amazon alone. The e-commerce boom of 2020 sent that stock soaring, but investors have since concluded the company won't be able to keep up that pace of growth, and it has fallen. Another 16% is Tesla, which continues to be very highly priced. Elsewhere, the index brings retailers that profited from consumers being stuck at home, like Home Depot and Lowe's, alongside cruise lines, resort companies and travel agents. Despite the Omicron variant, the number of airline passengers taking US domestic flights this holiday season recovered to 82% of pre-pandemic levels. But is it still too soon to bet on travel's recovery? Well, to find out, let's ask David Sekera, Chief US Market Strategist at Morningstar. David, hi. Now, some of the companies here obviously did very well from the pandemic, but which now are looking like they're overvalued as the economy goes back to normal?
Well, as you mentioned, the home improvement sector has certainly done, extremely well over the past 2 years. But at this point, we probably think that's one of the more overextended areas within the consumer cyclicals. So again, homeowners, they've used the past 2 years in order to be able to, catch up with all those home improvements they've been putting off before then. But then also, I think it probably pulled forward an amount of the improvements that they were looking to do, just as people were spending more time both at home for leisure and work. So Home Depot and Lowe's, they've certainly captured the preponderance of those sales. But at this point, we think Home Depot is 50% overvalued compared to our fair value, and Lowe's would be 30% overvalued compared to our fair value. Now, you also mentioned Tesla earlier too. That's another one that we think that Tesla has just ramped up, too far compared to our long-term forecast. Tesla's trading at a 50% premium to our fair value. We just think that investors are just overestimating the number of new cars that they'll build and the amount of market share that they will get in the long term.
If we look at retail more broadly, of course, the sector has been struggling with supply chain problems and high inflation. And on Friday, retail sales figures for December disappointed. But I know that you think that the results coming out in the next couple of weeks will actually look quite rosy for retailers' bottom lines. So why is that?
Well, I don't think the December retail sales number was quite as discouraging as I think the headlines, may make it out to be. So again, while they were down on a month-over-month basis, they were still about 17% higher than they were, the prior year. So I think you also have to remember that the U.S. consumers were well aware of the supply chain issues that we had coming into the holiday season this year. So a lot of those holiday sales, not only were they pulled forward into November, but they're actually pulled forward into October as well. So when I think about the sales, occurring earlier in the season, I think a lot of consumers were more concerned about being able to find what they wanted to be able to purchase, as opposed to necessarily being concerned about trying to get the absolute low price. So as such, I think discounting this year will be probably pretty low, and I think that's going to help be a boost to the operating margins. The other thing I find that's interesting this year is I think this is really the first time that we see, a significant amount of the evolution in the retail channel as retailers are moving from being, dependent really just on their physical stores, more into that omni-channel approach where we're starting to see them blend both the physical, the online, and the mobile presence.
Where else then can investors find value among consumer cyclicals? Is it finally time to buy those really hard-hit stocks like casinos and cruise lines?
We do think a lot of those are very undervalued for long-term investors. So as far as the pandemic goes, we do think we're at the early stages of the pandemic now starting to evolve to being endemic. And of course, it's impossible to know exactly when we're going to turn the corner on that, but we do see that consumer behavior is continuing to trend back towards pre-pandemic type of levels. So we think those stocks that are leveraged to some of those areas that have been hardest hit in the pandemic are certainly poised to rebound this year. In the travel sector, two stocks we think are undervalued to be TripAdvisor and Booking. As you mentioned, we think all three of the major cruise lines, Carnival, Norwegian, and Royal, are all undervalued as well. In the gaming sector, Caesars would be the one that I would highlight, for US investors is probably the most undervalued. But for investors who are also looking for, some exposure to gaming in China, Las Vegas and Wynn would be two that I would recommend there as well. We did mention a little bit about the retail sector. So again, we do think that foot traffic is going to continue to recover over time. A couple companies that I would mention there that we think are undervalued, Bath and Body Works, Williams-Sonoma, and Nordstrom would be a few.
Briefly then, given what a mixed picture we see in consumer cyclicals, how should retail investors handle it?
Well, I think 2022 is really shaping up to be a year in which stock picking is going to be especially important. So in the past couple of years, being able to pick sectors and be able to pick more of the pandemic trends, has certainly been able to benefit investors that have been able to do that. And I think the consumer cyclical sector is really going to be emblematic this year of that kind of stock picking requirement that we're going to need to see. So in the consumer cyclical sector, it's interesting that to us, from a valuation point of view, it takes a bit of a barbell approach that we see a lot of stocks that are overvalued, but then also a lot of stocks that are undervalued, with fairly valued stocks being kind of a small percentage, in between. So again, it's not really just being able to make the sector calls, but be able to pick those undervalued situations and then also steer away from those that are overvalued.
Thanks so much for that insight, David Sekera, Chief US Market Strategist at Morningstar. Well, before I go, let's take a look at some of the stories making news in this sector. Starbucks is to distribute its coffees via China's biggest food delivery firm, Meituan. The American chain has seen sales slow in China due to COVID-19 as rivals, including Italy's Lavazza and Canada's Tim Horton, expand in the world's second biggest economy. Meituan will offer coffee shop bookings as well as home delivery, and its shares rose more than 5% on the news. The world's biggest gambling hub, Macau, is tightening its grip on casino operators. The territory's new gaming bill would limit the number of casino licenses to 6 and halve their term to 10 years. Hong Kong-traded subsidiaries of Las Vegas Sands, Wynn Resorts and MGM Resorts all operate casinos in Macau, which in 2019 raked in $36.5 billion from its casinos, more than 6 times the taking of the Las Vegas Strip. And Elon Musk has announced plans to visit Tesla's factory in Berlin next month. The facility was expected to start production of its Model Y cars by December, but has yet to receive a license amid bureaucratic hurdles and an ongoing court case over the factory's water use. A first hearing is due on the 11th of February. The factory is intended to produce 500,000 cars a year, far outstripping German competitors. And that's your roundup of the US consumer cyclical sector. I'm Elena Casas, and this is Reuters.